Now, the second exercise, however, has a little bit of that new information that we've covered in the past video, where if we imagine that this company, Cars Plus, has a customer, Angela Sosa, who purchases $132,980 worth of car parts using the credit card. The cost to the Car Plus for the sale is $86,250. Standard credit card charges Cars Plus a fee of $4% of the sale. Now, what this exactly means, so it's very similar to what we've done so far, except in this case, the purchase is made using this credit card. So what happens is that on October 18, Cars Plus records sales credit of $132,980 on the credit side. However, normally we would write that we have account receivable debit, the same price, the same amount, except in this case the payment was made using the credit card. Therefore, and we know the charge for using the credit card is 4% that is supposed to be paid by the Cars Plus. So what is going to be recorded is Cars Plus is going to record, just a second, account receivable. Where is that? Oh yeah, that's the one. I'm sorry, I almost lost my thought. And let me just calculate it very quickly using my calculator. So we have 132,980 multiplied by 4%. That's 5,000. So I can immediately write it here. So credit card expense for the Cars Plus for this company is going to be 5,319.2, and the remaining is 127,660.8 is going to be accounts receivable. All you have to understand about this is that in this case, this retail company, Cars Plus, is paying to the credit card company a specific fee for allowing them to be used in the company, to be charging or using this as a method of payment. And so that 4% is going to be charged to the credit card expense, and Cars Plus is going to be paying this 4% fee. Now, everything else is going to be recorded equally the same way as before. So cost of goods sold, we already know the cost of goods sold is 86,250. Our merchandising inventory, by our I mean the Cars Plus merchandising inventory, is reducing through the credit side, and this is the entry that you have to make to record for the change in the inventory. However, this specifically this part is something new, and I do hope that you understand how it works. If you don't, we still can discuss it. You can comment it under the video, and I can always answer to your questions regarding this one. But I hope that this makes sense. Now, moving on to the next exercise that is related to our direct write-off method, where we discussed how companies recognize bad debt. So let me just write it here. So this is the bad debt direct write-off method. Direct write-off method. So I don't really have much space in here, but let's just do it in a new slide that I'll create. Let's use the blank one. So let's remove this, and I will be doing the writing in here. So what we know so far is that Window World extended credit to customer Niall Jenkins in the amount of $130,900 on the April 2nd. The terms of the sale are known, and the cost of the purchase is $56,200. So we immediately can make that entry, which is what we basically recognize the sale Again, we're doing the accounting from the perspective of the window world. This is the sale that has happened, so we're going to record sale. 100, if I'm not mistaken, 3,900. That was it, right? Yes, and the purchase or the sale was made on credit. Account receivable is going to be recognized through debit, 130,900. And we immediately can also immediately record here cost of goods sold. Cost of goods sold is, sorry, how much was that? 56,200. 56,200. Again, we're following the perpetual inventory system. That's why we have to recognize the change in the merchandising inventory and the cost of goods sold. Yeah, so this is the entry made on April, if I'm not mistaken, that was April 2nd. Yeah, so far so good, but on September 4, the window, yeah, here, so the window world determined that Niall Jenkins' account was uncollectible, and he writes off the debt immediately. Yeah, so we immediately write off the debt, and this is how we make that entry, and that is bad debt expense account is going to increase in full amount. Yeah, so this is all of that, 900, and accounts receivable. Oh, sorry, I already have it there. Yeah, accounts receivable is going to be written off through credit side. So this is the very simple direct write-off method. Yeah, so far this is how we do it when the company is using the direct write-off method. Now let's assume, if we continue with the example, and we assume that is there the payback? Yeah, on December 3, the customer unexpectedly paid in the full amount on his account. So since we've already written off in this red colored sort of note all of the debt, now we have to reverse it to be able to get that cash back. So in the red colored entry, we assume that that's it. Mr. Jenkins or whoever will not be able to pay back his debt. But now he says that, oh, I'm sorry, I was in a bad situation financial, but now I'm fine. I can pay back the debt, so I will do it. So this is how we're going to record that. And let me maybe change the color to show you the reversing entry. The reversing entry is going to be very simple. So bad debt is going to go, yeah, 0. So we've zeroed it out. There's no more bad debt. And this 130,900 is brought back to account receivable debit side. This is the reversing entry. And if we go back again and continue with the proper entries of the cash payment entries, cash payment has been received, yeah, 130,900, and account receivable is legitimately has been, not written off but paid back in this account. That's it. This is how you do it in case of the direct write-off, when you recognize there is a customer who cannot pay back his debt, but eventually, and you write it off. But even if he pays it back at some point in time, you can always reverse it and still make that cash debit and account receivable credit type of an entry. Yeah, so this was the direct write-off method. And let's very quickly look at what it is, the allowance method. So the explanation of the allowance method was in our previous video, so make sure to check that out if you don't remember the theory. But it's actually also very, very simple. So let's take a look at the example. So in our case here, it says that Millennium Associates, records bad debt at first. So we first have to make the assumption or estimation of how much of the bad debt will occur during the year. And we use in this case, again, this is bad debt recognition or bad debt, but using the allowance method, not direct write-off method, but the allowance method. Now we're using the allowance method, and we first make an estimation of how much we assume or we think our company will not be able to collect the debt from its customers. So in this case, they're using what they called an income statement method, meaning that the way to estimate how much that will be is to use the credit sales. Yeah, so they know the credit sales, which we usually can find where? In the income statement, income statement. And the credit sales amount is $773,270. And we know that amount. And the company assumes that about 3.2% of this amount, of the credit sales amount, will not be collected. Yeah. So when and let's look at the first one. Yeah, A, year-end adjusting entry for 2017, bad debt. The bad debt adjusting entry means that this is only an estimation, and this is how we make it. The bad debt expense is going to be debited. How much that was? Just a second. So we multiply 773,270 by 3.2%, and that's 24,744.64. Yeah, so this is the amount. And the second entry will be an allowance for doubtful accounts, very handful accounts, and that one will be credited 24,744.64. Yeah, so this account, this specific account, let me just write it down. This is a contra asset account of account receivable. Yeah, so this will be placed against the account receivable. Allowance for doubtful accounts, 24,744.64. So this part is only an estimation. Yeah, here we made an estimation using our credit sales amount, and we'll multiply by 3.2%, and we'll find this amount. Yeah, so this is basically the B solution. Sorry, for solution A. Solution. Let's make it neatly. Solution A. And moving on to solution to the task B, where on February 5, 2018, identification entry. So what happens is that on February 5, Millennium Associates identified one uncollectible amount from Moller Corp, and the amount is 1,330. So all we have here in the task B was the estimation. So how much we think all of our customers or amount among all of our sales will not be collected. Yeah, but now we have finally identified that uncollectible. So now we can write it off. And how do we write it off? Let me just change the color to green. This will be the write-off. Yeah, the allowance for doubtful accounts will be reduced by through the debit side, 1,330, and account receivable, which already is supposed to have some kind of balance, right? Because there are receivables, will be reduced through the credit side, 1,330. This is very simple. This is just the write-off. Yeah. So with the green color, we write off the bad debt. So it's no more in our books. So that was B. And let's move on to the C. Yeah. The Moller Corp unexpectedly pays back its account. Yeah. Let me just go back again to my blue color. Moller Corp is saying that now they can pay back the amount in full, a bit late, but still they can pay it back. Now all I have to do is reverse the entry in the C. Yeah, in the C, I will reverse the entry. Again, let me use a different color. The reversing entry will be account receivable will be increased again through the debit side. Allowance for doubtful accounts will be again increased. Yeah, so this is just exact opposite of the green color entries. Yeah, so this is reversing entries. And the cash payment will be received. Sorry, this one. And accounts receivable will be, reduced through the credit side. That's it. So this is how we do it. All we have in case of the difference between the direct write-off is that in the allowance method you have original estimation, which is this one. Yeah, so this one is that estimation that you first have to make. You make an allowance of how much you think the company will not be able to collect, whereas in the direct write-off you first have to identify. Yeah, so you identify your unpayable to uncollectible customer, and only then you make that a write-off. You don't make any estimations. I hope that helps you. I hope you understand this what is it, the bad debt situation much better. You understand the allowance method, you understand the direct write-off method. And again, if you have some questions, if you still have some points that you don't understand, I'm always up for the question and answer, either through the YouTube comment section or by any other means that you know.